let's take a look at problem 7.1a. As you can see, this is our first problem on CVP analysis. That stands for cost volume profit analysis. We'll be computing the margin of safety, degree of operating leverage, and doing lots of break-even types of calculations. So to do it, at the beginning of our Module 7, right after the sort of title page to the chapter, I've included this formula sheet, and I'm going to be referring back and forth to it throughout my time in answering this problem. So just make sure you know where it is. It's just at the beginning of Module 7, and you can have a copy for yourself. Okay, so let's begin the problem. The question says, Charming Clothiers manufactures neckties and bow ties. The company has the following information. The company's sales price is $30 a unit. The variable cost of producing bow ties is $18 per unit. The company expects to have fixed costs of $60,000 next year. The company expects to sell 8,000 bow ties next year. Assume no taxes. So that makes our life a little bit easier. Okay, before I get to any part of this question, here's all my data, right? This first paragraph is like nothing there, really. This is all the data I really need. What I like to do is I like to say, okay, what information do I have? And I like to format it in this way, and this will come in handy for you. S, V, E, C, M, F, E, and I'll call it net income, but it's really net income before taxes, NI. So S is the sales revenue, VE, variable expenses. CM is contribution margin, that's sales minus variable expenses. FE is fixed expenses, and NI is net income, again, excluding taxes, which we'll worry about in problem 7.3. I think we will tackle a problem with some taxes. Okay. So let's fill in the information we have. And we're going to be given both information that's per unit and in total. And so let's do what we can with that information. So the sales price, $30 a unit. Okay, so my S is $30 per unit. Again, there's a question here that I haven't even read, A, B, C, D, F, G, but I'm just going to fill in what information I can. Variable expenses of producing bow ties, $18 a unit. Company expects to have fixed cost of $60,000 next year. So fixed expenses, it's not $60,000 a unit, it's just $60,000. And we know we're expecting to sell 8,000 bow ties next year, so we can actually figure out a total then, right? 30 times, not 80,000, but 8,000. 30 times 8,000 is $240,000. And 18 times 8,000 is $144,000. And going to our formula sheet, and this is something you'll learn very quickly. It's the first formula on the sheet. Sales minus variable expenses equals contribution margin. So I know that 240 minus 144 is going to give us our CM, and our CM is going to be 96 here. And I can also figure out, well, CM minus fixed expenses is going to give us our profit, or our profit before taxes, of 36,000. We can also figure out a CM per unit. 30 minus 18 is 12. And if you look at formula 1A, selling price per unit, that's $30. Variable expenses per unit is 18. So 30 minus 18 is 12. So that is indeed true. So we actually were able to fill out our whole chart. Some questions you're not able to fill out this whole chart at the start, but this one we were. So good for us. I'm just going to erase these multiplication signs because they aren't really going to be needed here. So we don't do fixed. You might say, well, why didn't I don't know why I scrolled up there. Why didn't I divide 60,000 divided by 8,000? And 60,000 divided by 8,000 is like, 7.5. Why didn't I take that? 7.5 per unit. Fixed expenses, we don't examine on a per unit basis. If sales go up by 100 units, our fixed expenses won't change. That's what makes them fixed. If sales go up by 100 units, our variable expenses do change. Our sales do change. Our contribution margin does change. So that's why we will consider those on a per unit basis. So fixed expenses and net income per unit, we really will not be filling in this information. So kind of black that out. So this is a fully filled out table, and it's going to be so useful as I continue the problem. And I think I've used all of that information. I've just laid out, like I've just taken this information and put it in a different way, right? Looking at the information in this way, if you can do it in a CVP question or a break-even question, you are so far ahead of the game, it's not even funny. You're just really doing well if you can get your information to sort of format that way. So question A, calculate the break-even point in units. Okay, so A is going to be break-even units. Let's go up to our formula sheet and see if we can find anything about break-even point in units. Look at that. It's number 3. Fixed expenses divided by CM per unit. So BE units is fixed expenses divided by CM per unit. Okay, what are my fixed expenses? Well, 60 grand. What's my CM per unit? 12. So we've done that work for a reason. Oh, I forgot I was doing this all in red pen. Switch to my black pen. Let's switch back to red. 60,000 divided by 12. What's 60,000 divided by 12? 60,000 divided by 12 is 5,000 units. Okay, so I've mechanically gone through this, but what the heck does it mean? What this means is if my company sells 5,000 units, I will break even. Now, what does break even mean? It means it's the point at which I make zero profit, I make zero loss. If I sell one more unit, I'm going to make a little bit of money. If I sell one fewer units, I'm going to be money losing. I need to sell 5,000 units to break even. And it should make sense. I mean, remember our budget, our total is based on 8,000 units, and we're making a little bit of money because it's more than 5,000. If our budget was based on 4,000 units, we'd have been losing a little bit of money. So break-even point in units is how many units it takes to break even. Last chapter, we learned about splitting costs into their variable and fixed components, and this is why that's so valuable and so important, because you can do things like compute the break-even point. Okay, let's look at B. Break-even point in dollars. So the question says, calculate the break-even point in dollars. We can do this one of two ways. The easy way is Formula 3. The harder way is Formula 4, but, well, frankly, they're both pretty easy. Let's do both ways. So break-even point in dollars is break-even units times selling price per unit. So we already have our break-even units, 5,000. That's our break-even units. And it's multiply that by the selling price, 30. 5,000 times 30 is $150,000. And all it's saying is, look, it's nice to know how many units I need to sell to break even, but what is my selling price? How many dollars sold do I need to break even? And so I need to sell $150,000 worth of my product. This is a great moment, by the way. Right here is a great moment if you're just starting a business to do a little thing I call the sniff test. You sort of say, okay, does my business idea have merit or does it stink? Does it pass the sniff test or not? And in answer to that question here, does our business pass the sniff test? Well, we need to say, is it likely I'll sell 5,000 units this year? And you can even say, okay, I'm going to be open for 300 days. So 5,000 units in 300 days means I need to be selling, I can't do the math in my head, something like 17 units a day, 16.6 units per day. Can I sell 16.6 of whatever it is I'm selling a day, sets of knives or whatever it is that I happen to have as a company? Well, if you can, great. But if you can't, you should be very honest with yourself and change something about the model. So this is a great very realistic situation for a company to say, okay, this is my break-even point in units. Can I do it? Okay, next. How many units must be a company sell to reach a target profit of $50,000? And again, assuming no taxes. So let's see, targets. Oh, I told you I'd do it two ways. Sorry. I told you I'd do break-even dollars both this way, and I haven't done number 4. So it says break-even point in dollars is fixed expenses divided by CM ratio. Well, to get CM ratio, we actually need this one, and it's CM divided by sales. I actually should have done something, an extra column here that's actually pretty relevant, is to put these 3 items in percentage terms. So sales we set as 100%. We say what percentage of sales is variable expenses? Well, it's 18 out of 30. 18 divided by 30 is 60%, and 12 divided by 30 is 40%. It's important to know these in percentage terms. So our CM ratio is CM divided by sales. Now, it can either be per unit or in total, 96 divided by 240 or 12 divided by 30. We just did 12 divided by 30. It's 0.4 or 40%. Okay, so there's our CM ratio. So break-even dollars equals fixed expenses divided by CM ratio. We know our fixed expenses. They're $60,000. We now know our CM ratio is 40% or 0.4. I'll pull out my calculator just to prove this number because I can't do the math in my head, and I do want to show you the math. There's my calculator. So 60,000 divided by 0.4, which is 40%, and that is $150,000. They're the same answer. Now, if you're a student in one of my classes, I'll never tell you how to calculate these. Some questions will say, oh, use this formula or use the equation method or use some other method. I'm not interested in that. I just want you to get the answer. So again, your teacher might be a little bit specific in how they ask you to do it. I'm only going to show you the way that I think is best and the way that I certainly understand the best. Okay. Let's move on to part C. How many units must the company sell to reach a target profit of $50,000? Okay, so this one's target sales in units. So how many units do we have to sell to reach a target profit? So it's formula 7. Fixed expenses plus target profit divided by CM per unit. We know our fixed expenses. Our fixed expenses are 60 grand. We know our target. Our target is 50. And we know our contribution margin per unit is 12. And again, that's just up here. So, let's just think about this, take a bit of a step back before I do the computation, although it's an easy computation. Let's think about what we're trying to do here. We're saying most companies, if you go into business, you want to go into business for more than breaking even. You want to make a little bit of money. Breaking even is not sufficient for most businesses. Some businesses with a social purpose, perhaps breaking even is enough, but most companies that are running want to make profit. Even social enterprises want to sort of be efficient, and this is one measure of that, or one way to sort of target making some money. So 60 plus 50 is 110. 110 divided by 12, I have no idea. 9167, right? We can't sell a decimal, a fractional unit. So what does this mean? In order to make my target profit of 50 grand, I need to sell 9,100 units. I'm only budgeting to sell 8,000 units. At 8,000 units, I make 36,000, as you can see. If I change that number up there to 9167 and change all the numbers beneath, you'll see I make my target profit slightly over because I round it up here. Moving on to D. Prepare a budgeted contribution format income statement. Okay, so a contribution format income statement, we're going to title, it's going to be Charming Clothiers. We are preparing an income statement. We can put in brackets contribution format. And this is for a year, for the year ended. And they don't give us dates here. We don't get fiscal years. So let's just assume it's a December 31st year end. And we should note that this is a budgeted income statement, right? This is not an actual income statement. So we start with our sales revenue, and our projected sales revenue is 240 grand. With a normal conventional income statement, we'll go sales minus cost of goods sold is gross profit minus our operating expenses and so on. Here we don't do that. We go sales minus variable expenses. This is what makes this a contribution format income statement. Sales minus variable expenses. And variable expenses were 144 equals contribution margin rather than gross profit. 240 minus 44 is 96. Contribution margin minus fixed expenses. As I recall, our fixed expenses were 60. Gives us a net income before tax, or an operating income, I'll call it, of $36,000. Dollar sign at the top, dollar sign at the bottom, and we've got ourselves a good contribution format income statement. Okay, I'd like to do one more part of the problem before I take a little break. So we'll break this into two parts. Compute the margin of safety in both dollar and percentage terms. Okay, margin of safety. Where is that? Oh, it's formula 10, safety margin. Budgeted sales minus break-even sales. And this is in dollars. Okay, so budgeted sales dollars. Well, according to our budget, we're expecting to sell, and this is a budget, 8,000 bow ties, and at 8,000 bow ties, sales will be $240,000. So budgeted sales, where are we? E. Minus break-even sales, and this is in dollars. So our budgeted sales in dollars, 240 grand. Our break-even sales in dollars, break-even dollars, we did it in point B, 150 grand. So 240 minus 150 is $90,000. Okay, so what does this tell us? This is our margin of safety. What does the margin of safety tell us? It says, look, if my sales can drop up to $90,000 and I'm still making money. If my sales drop by $89,999, I'm still making a little bit of money. That's how much wiggle room I have here. If my budget is off by more than 90 grand, I'm going to be losing money. But if my budget is within reasonable amount, let's just say my budget's off by 40 grand. Well, I still make money. I'm still going to make some money. My sales can drop by up to 90 grand before I lose money. That's what this formula means. The next part asks us to present this in percentage form. All you do is you take your margin of safety divided by your budgeted sales. So margin of safety, 90, divided by our budgeted sales of 240. 90 divided by 240. I know it. 37.5. Let's see. All right. Once in a while, I get them. 37.5%. What does that mean? Same thing as the one above. It just puts it in percentage terms. It says, look, if our sales are 37% below what I budgeted, I'll still be okay, right? I've got 37% wiggle room. I can be 37% off. If I'm 50% off or 40% off, yeah, I'm in a bit of trouble. But if I'm only 37% off, I'm still, my head is still above the water. Okay, I'm going to stop this video here. In the next video, we're going to talk about the degree of operating leverage, and I'll spend quite a bit of time explaining that concept. So stay tuned for the next video.